Tech firms have been firing thousands of employees in recent months. Over 120,000 employees are expected to have lost their jobs in 2022 alone at some of the largest names in technology, including Meta, Amazon, Netflix, and eventually Google, as well as smaller businesses and startups. Over 100,000 employees have been laid off by big US technology businesses in January alone, with the majority of the companies blaming the layoffs on gloomy economic forecasts and recessionary fear. Elon Musk is rumored to have let off half of the staff when he took over at the end of the previous year. Microsoft indicated it will let go of 10,000 staff members, and Amazon started a new round of layoffs that are anticipated to affect more than 18,000 workers, making it the biggest workforce drop in the e-retailer's 28-year history. Hello, and welcome to Mad Over Business, where we aim to help you transform your financial future through real-life business stories. In this video, we'll examine how major technology companies are laying off workers in light of the impending global recession. We will look into the reasons that have an impact on these businesses, and then look into what the future may hold. We hope this video provides you with some new insights. So let's go. Google recently executed its largest layoff in the company's history. The firm decided to lay off 12,000 employees all at once with no warning to the affected employees. The fired employees are now known as the Golden 12K, a new nomenclature that has appeared on various platforms. Sundar Pichai fired 12,000 Google employees, about 6% of the overall workforce. Google, on the other hand, made certain that the staff were well compensated. If you were wondering why they are called Golden when they were asked to leave, it is because the high severance pay money granted to Google employees who were laid off. In response to the widespread layoffs, Sundar Pichai stated that his business hired during the past 2 years of rapid expansion for a different economic reality than the one we confront now. Pichai also noted the use of AI as a driver for improved performance in the future. The most significant job losses in the past 3 years, according to Layoffs.yi, a website that has been tracking tech layoffs since the start of the COVID-19 outbreak, have come from both Microsoft and Alphabet. In the past 3 months, just Amazon, Alphabet, Microsoft, and Meta have let go of more than 50,000 employees, and analysts anticipate that this wave of widespread layoffs will persist all the way through 2023. Okay, so why are these sudden layoffs in the technology industry? There are two primary categories of factors which affect the employment. Factors internal to the organizations like Google, Amazon, or any other tech firm. These can be overstaffing, cost-cutting, investor pressure, and automation and factors outside of the control of these said organizations. These can be fear of global recessions, weak consumer demand, rate hikes, and imitation. Let's dive a little deeper. This significant round of layoffs is, in many respects, a correction for an earlier error. Our online lives ended up being our only ones during the epidemic years. There were no Saturday night bars, no commuting to work, pick-up basketball games, or dance recitals. We were all compelled to stay at home, which resulted in more internet time. Online shopping has developed into the only retail outlet, not merely a growing one. Not only have Netflix, Amazon Prime, and other countless streaming services replaced movies, but also dining out, lunch breaks at work, and dating nights. Despite the upheaval in the world, this increase in internet activity was beneficial for tech firms. They brought in record high revenue, which led to record high profits, and a hiring frenzy that resulted in high compensation and perks for engineers, developers, and other tech professionals. Many tech firms thought this was the start of a new normal. The world's office workers almost all switched to working from home, which resulted in significant change in how we lived. Tech businesses employed in line with their expectations that this transformation would become permanent. They rapidly increased in size, built new teams, and generally developed. This was made worse by the equipment for built-in redundancy in big firms. So what is redundancy? If a team at a big tech firm like Google requires 25 staff members to keep the applications they work on running and stable, that team will likely need 30 or more actual employees. Not because there is enough work for 30 engineers to do on a daily basis, but to provide protection to the company in the event of several key staff leave. The final outcome? Too many individuals were hired by tech companies. and these are highly skilled software engineers and developers earning low to mid six-figure salaries, not part-time administrative assistants making $10 an hour. Not to mention the comprehensive packages, excellent benefits, amenities, and even stock options. Redundancy requires some overstaffing, but it's obvious in many businesses. It's gone too far. This issue would not be a huge problem if the growth prospects in tech were strong. Hiring too many people isn't a problem if you just hired them too soon. While it isn't ideal, it won't break the bank for corporations like Meta or Alphabet. The problem is that the immediate future does not appear to be promising. For months, we've been hearing that the United States is about to enter a recession. Coinbase CEO Brian Armstrong was among the first to call it out, with Elon Musk, Facebook CEO Mark Zuckerberg, Amazon CEO Jeff Bezos, and many more following in recent months. A recession would result in fewer consumer purchasing and, more crucially, lower advertising spending for many technology companies. Meta particularly highlighted this on the Q3 earnings call, noting that they expected Q4 and early 2023 advertising to come in lower than it has been. So who is the fault for making such choices? The co-founders of Stripe, a $74 billion payment startup, took responsibility when they fired more than 1,000 workers this month. They wrote, "We overhired for the world we're in. We're much too optimistic." Jack Dorsey, founder and former CEO of the social media platform, took ownership of Elon Musk's decision to cut half the number of employees at Twitter last week. He said on Twitter that "I grew the company size too quickly." Mark Zuckerberg, Facebook CEO, cited the overly aggressive expansion as the reason for Meta, the parent company of Facebook and Instagram, losing 11,000 employees or 13% of its workforce. Over the past 3 years, Meta's headcount has doubled to 87,314 individuals, pushing its valuation beyond $1 trillion. In a message to the staff, he stated, "I made the decision to significantly increase our investments. Unfortunately, this did not play out the way I expected." Because of the macroeconomic issues that contributed to the current crisis, many people think the crisis will persist longer. Low interest rates over the previous 10 years encourage investors to invest in riskier but more lucrative assets. These investors favored rapid expansion over profit margins and rewarded risk-taking businesses. Thus, in recent years, tech companies have poured money into sales and marketing, hiring, acquisitions, and experimental ventures as a response to the influx of cash from investors and a quickly expanding business. The increase in employees due to the additional capital fueled the talent war. According to Reuters, Google's staff reduction is the result of investor pressure to pursue a more aggressive strategy to curb spending. TCI Fund Management encouraged Alphabet in an open letter in November to publicly define a target for profit margins, accelerate share buybacks, and cut losses in its portfolio of Alphabet's Moonshot subsidiary. The company has too many employees, and the cost per employee is too expensive, TCI Managing Director Chris Hone said, noting that Alphabet's employment has grown at a 20% annual rate since 2017. There have also been instances of layoffs in the IT sector, which are essentially examples of social contagion, in which organizations mimic what others are doing. Businesses' most popular excuse for layoff is that it's what everyone else is doing. Layoffs are unsubstantiated by evidence and are the product of imitation. A sluggish demand since the beginning of 2022 has also impacted the tech sector. The world has faced enormous challenges in the form of high inflation and sluggish demand. In the aftermath of the global crisis, consumer price inflation has skyrocketed in practically every major country around the world, including the United States, the United Kingdom, India, Japan, the European Union, and others. The impact is being felt much more acutely now, as the world economy has been under strain from COVID-related lockdowns since 2020. Just when things appeared to be improving, the war between Russia and Ukraine exacerbated the issue by interrupting a crucial trade route. Which job roles have been most impacted by the ongoing global tech layoffs? It is interesting to observe that HR roles and job functions, which accounted for 28% of all layoffs, were those that were most affected. There are two possible explanations for this. First, if businesses are firing employees, it stands to reason that they will be reducing hiring, which reduces the need for HR staff. However, a second, possibly as important issue is that some HR-related tasks are being replaced by automation. There are existing platforms that try to automate common procedures associated with hiring new employees, like checking references, confirming IDs, and conducting health and safety checks. From company to company, the impact of downsizing has been borne into different roles. At Google and Twitter, software engineers bore the brunt of the downsizing, while HR and talent sourcing were most negatively impacted at Microsoft and Meta. According to the data gathered by 365 Data Science, women made up a slim majority, 56%, of the employees that were let go. This is concerning because the tech sector has worked hard over the past 10 years to eliminate the gender gap that is already evident in the business, particularly in technical and engineering roles. It's entirely possible that a sizable portion of the employees that have been laid off may decide to enter self-employment or the gig economy. So what does the future look like? Will it get better? Let's try to look objectively. While layoffs are extremely damaging to those affected, their numbers are insufficient to make a significant difference in the enormous IT job market. When compared to the total number of employees, the number of tech layoffs is small. According to CompTIA data, the US tech industry, which includes companies such as Google and Apple, gained employees for the 25th consecutive month in December. The number of people working in tech occupations, defined by the association as computer-related technical roles, such as software developer, network engineer, and data analyst, reached a new high of 6.5 million that month, and their unemployment rate was near a new low of 1.8%, compared to 3.5% for all jobs. It's possible that those figures moved in January, but tens of thousands of layoffs won't make much of a difference in an industry of millions. According to CompTIA, the majority of people with tech jobs, 59%, do not work in the tech business. This statistic has stayed fairly consistent throughout the last decade. This is because when organizations in banking, healthcare, and retail began to require more computer personnel to help them digitize and automate their operations, the tech industry, particular software development, increased as well. However, in the coming months and years, the balance may shift even further in favor of non-tech enterprises. Engineers and other workers with in-demand tech skills will most likely have the easiest time finding new jobs wherever they go. According to a December 2022 report from the tech hiring platform Dice, there were over 300,000 job ads for tech workers in December, which was lower than the peak but fairly consistent with the previous 40 years. Finance, manufacturing, and healthcare are all the largest and fastest growing areas for tech workers. Meanwhile, among the top employers of tech talent are corporate behemoths such as Wells Fargo, General Motors, and Anthem Blue Cross. Companies outside of tech that couldn't pay such high compensation or didn't have the cultural attraction of the Googles of the world can now hire the tech people they've long desired if they make themselves appealing enough. Those additional jobs, though, will not be cheap. While salary is still the most important factor attracting IT professionals to a job, it has been for a long time the number 2 item on that list, according to a recent Gartner survey shared with Recode. It's a new addition: work-life integration. What do you guys think about the current situation? How bright does the future look? Comment your thoughts below. We'd love to get your insights. For more such business stories, subscribe to our channel and we will bring you the most interesting stories from around the globe. Whether it's overcoming obstacles, making a difference, or achieving financial goals, these stories will entertain you and motivate you to achieve your own business and financial aspirations.